Welcome to the Adventures in CRE Audio Series. Join Michael Belasco and Spencer Burton as they pull back the curtain on everything commercial real estate and introduce you to some of the top minds in the industry. If you want to take your skills to the next level and be part of a growing community of CRE professionals across the world, this is for you.
Hello and welcome back to the Adventures in CRE Audio Series. My name is Sam Carlson. Normally, I will kind of, frame out the conversation and introduce the guest, but I'm actually going to dip it over to Spencer. He's going to tell us what we're talking about, and we'll take it from there.
Yeah, I'm really excited for our guest today, Brandt Foster. Brandt's a former colleague of mine, and it's one of the reasons I was so excited to have him on the podcast. This is a rarity for us. So first off, intro for Brandt. Brandt's 16, 17 years on the institutional side of commercial real estate, 12 years as a director of real estate at one of the largest real estate investment firms in the country, Northwestern Mutual Real Estate. But the primary reason we brought Brandt on, and this is really fascinating for me, is Brandt and his the predecessor, the individual who trained Brandt. They are some of the foremost experts on manufactured housing, the investment in manufactured housing communities across the country. Have put out, I'm guessing, some of the largest dollar amounts into this space of really anyone in the country. And so Brandt brings a perspective into a niche of real estate that is far deeper than most people we ever bring on the podcast. So Brandt, thank you so much for your time. I know you're busy. You're Atlanta-based.
That's right. Thank you. Appreciate it. And, looking forward to this.
Sure. So let's start. What is MHC? When I I'm going to be using that throughout the podcast. When I say MHC, what does that encompass when you're looking at investments and what would you classify as an MHC investment?
Yeah, I'd say, well, first off, the acronym is Manufactured Housing Community. And within, from an institutional perspective, I guess you could say that means there's multiple different tiers of property types that sit within that. There are manufactured housing communities, pure MH communities, and I don't know how detailed your listeners understand the space, and maybe I could kind of explain it high level, but essentially the owner of the community would own the dirt, the land, and then all the individual homeowners would own their own homes and pay what effectively is land rent, lot rent. And that's why the dynamic is so interesting and obviously has become such a popular property type, is because of that dynamic. So your cash flow payments as your owner of MH or MHC is so secure. Now there's different tiers, and that's kind of what I was alluding to earlier. You've got the strongest and most, what I would consider, institutional caliber slice is 55 plus. So that's your senior manufactured housing communities. The characteristics of those are, generally speaking, they're all going to be, I would say 90% of this slice of the pie exists in Florida, California, Arizona, a little bit in places like South Carolina, Texas, Nevada, and then Oregon and Washington. So that's the bulk of your 55 plus assets sit in those regions. You've got some real nice stuff in the Northeast and in the Midwest in certain pockets, but geographically that's where most of it sits. And then the dynamic there is most of these are obviously retirees, and most of them buy their homes with cash. So a lot of them, this is either a second home or the John Jacobs, who was my predecessor and mentor in the space, always basically gave the example of, John and Sue in Detroit retires after 40 years at the Ford plant, moves down to Venice, Florida, buys a MH home for $50,000 cash, and that's their retirement, and that is kind of your core renter. So it's obviously and within the various communities you have different tiers of economic strength and household incomes, but that's kind of the core example of 55 plus. Um, I said a lot there,
Yeah, let me
so
stop there for a second because this is this is the attractiveness of this investment. So let's take, I think Bob and Sue was Brandt's example, coming down from Detroit, spending 50,000 of their retirement dollars to buy a new manufactured home. That home is put on a lot. That lot is owned by investors such as Brandt. The Bob and Sue pay, say, $1,000 in lot rent for the privilege of placing their home that they own on that lot. And what's interesting, right? If you think about the economics, the waterfall of decisions that go into like what a household pays first and second and third when times get tough. If you're Bob and Sue and you have a $50,000 investment in a manufactured home, the first thing you're going to pay is that lot rent because you don't want to lose your $50,000 investment. And that's in contrast to, if I hold an FHA loan and I loan 97% to Bob and Sue who go buy a house in Florida and their mortgage is X, they only lose a 3% down payment, right? And their credit gets hurt and all those other things. But this lot rent, it is so incredibly safe. I cannot think of in real estate a safer investment, a safer position to be in than Branson. So, okay, so you described, call it the traditional MHC, home on lot,
yep.
investor owns lot, lessee owns home. You described the over 55. What's the differential? How do you differentiate between those over 55 communities
Right.
and say all age? How does the
Right,
risk
right.
increase with the
And
all age?
just to back up real quick, one of the a big metrics, and it exactly summarizes how you described it, is let's say, just for simplicity of math, the home was 60,000 on average, and the lot rent was $500. So the way I think of it, or the way a lot of folks think about it, is you essentially have 5 years of rent payments in equity protecting your collateral. So that, I mean, as long as those residents have equity in place above the dirt, your rent is virtually certain. And we can get into the rent growth dynamics, but essentially the way to think about this property type is it's a perfect inflation hedge. The way that all the leases are structured is it goes with CPI, and oftentimes it's more than CPI. It's CPI plus one, plus two, plus three. So right now, in this environment, when you're seeing these monster CPI numbers, apartment rent growth comes into question. Obviously, all the other property types, it's you're starting to dial back your rent growth assumptions. But in MH, you're like, well, per the letter of our lease, we're obligated to go up by CPI. Now, not all owners will do that. Some will probably back off to make it less painful and be good owners. But so that's another tremendous dynamic. Um,
Interesting. Yeah, the inflation hedge is fascinating.
yeah. So right now,
So what about all
yeah.
age?
So
How do you look at all age versus the over
yeah.
50?
So all age is and again, they run the gamut from in terms of quality. You could have an all age in California, which behaves and looks very similar to 55 plus in Florida or other areas, because in California the housing costs are so dramatically higher than anywhere else that and it's still such an incredible value proposition. So you could own let's just say a 150 or $200,000 manufactured home next to a residential neighborhood with $1 million homes. And so you can see the value proposition. Same dynamics. If your rent's 1,000, incredible amount of equity protecting your rent. So that would be the top crust all age aspect. And then it cascades down the scale. The homes are generally going to be worth less. The all age geography is spread much further throughout the United States. Um, and then you're much more reliant on the economy at that level, because it behaves more like an apartment. You still got some equity, but you do have loans, so there's less equity than the 55 plus place, and they're all reliant on their current incomes and jobs. Where at the 55 plus, they're all retired, they're getting a Social Security, pensions, whatever it may be. So it's just a less certain cash flow stream. Does that make sense?
Now, so that's, let's call it traditional MHC.
Yes.
How do you? What are some of the kind of variations in MHC? RV parks,
Mhm.
I've seen underwritten before. Are there any others? And
Yeah.
could you talk us through some
So
of those
then,
other?
then below, I'm say below, just to mentally think about it. You would have RV parks. So I think the three categories of MH, in my mind, are 55 plus, all age, and now what I would, this kind of catch-all category I would call RV parks. And RV parks are what they sound like, but within them, there's very lots and lots of different tiers of rental stalls and types of parks. So the way I would break it down is, well, really, there's a thing called park models, which are essentially small manufactured homes. So all the dynamics that we just talked about translate here, except the homes are less than usually 1,000 square feet, which sounds small, but then almost all of these are located in Arizona, Florida, California. So they put on big sunrooms, big patios, and it feels like a nice little home, perfect for retirees. Um, and then and same dynamics. They owe annual lot rent, and they have, there's no financing or very little financing for like park models. So that's all equity. So instead of that 50,000, maybe you're 30 or 25. So it's just, you can kind of see it's a little bit lower values. Um, and then, but a very certain and high, strong cash flow stream. Then below that, you've got what I'll call really the core RV components of these parks. And you have really three different tiers. You've got annual renters. So think about in Arizona, some of these parks are so popular. There's waiting lists for years to get a spot in some of these parks. And so Betty and Joe, who don't buy a mobile home, they buy an RV, um, uh, sign up and basically have the rights to a stall in Arizona. And that's guaranteed rent. So every year they're going to show up to that same stall, um, and park their RV there. Or what's happened is, they'll leave their RV there all year, and they don't really drive their RV. They'll just show up and live in their RV. So those would be your best, your most regular tier of income streams is what I would call annual. And in the industry, people may call these stuff different. This is just mentally how I assign things. But then you'll have a similar tier called seasonal.
Sure.
And so these would be folks that come down from, your snowbirds that would come down from January to um, April or May, and same kind of dynamic, but your rent's going to be higher. So you're going to pay more in rent to not pay the full 12 months, and it might end up being pretty similar to the annual level. But again, that RV is literally driving in and driving out, um, in the summer months. So you can do an aerial. It's kind of cool. You can go to Phoenix, Phoenix MSA, and you obviously go over to like the East Valley, and change the months. So look at an aerial in January through March, and you'll see all the rooftops, all the RVs. They'll be full, and then change it to August or July, and you could kind of visually see the movement of literally your income streams from satellite. So it's kind of a cool thing to check out. And then the last tier would be pure transient. So that's purely like coming for 2 weeks, coming for a weekend, in and out, much higher per day rental rates, but obviously much more vacancy and volatility with that tier.
Yeah, that's interesting about the kind of the aerial in Arizona, seeing in real time how that shifts, and you can then understand how your risk is greater. There's more volatility in the RV versus the 55 plus MHC. That makes a lot of sense. Let's talk about trends in this space. So, look, everyone's been on TikTok and Instagram and YouTube, and we all see the people who are living out of their vans or whatever, and they're how much of this market are in the institutional side when you have an RV park or what? How much of this market is that versus how much of this market are the types of people you described, the over 55, the steady? And are you seeing any change because of that trend around a more nomadic world for some of the younger generation?
Um, I I would say the the big institutions and all the big players that have entered the space in the last 5 years are largely focused on the 55 plus, the all age space, and these really premier RV parks with a heavy amount of park model and annuals. Um, I would say the last 3 years, that's definitely, um, in terms of cap rates, there was, let's call it 100 basis, maybe 75 to 100 basis point spread between 55 plus and all age, and then probably 200 plus between RV and 55 plus. So that's kind of the gamut. What we've seen in the last 3 years is that definitely compress. So now you're 50 points, maybe 25 points between 55 plus and all age, and maybe 75 to 100 with RV. So that just tells me right there that a lot of money has moved into that RV space, which inherently has a lot of transient components to it, which is kind of what you're referencing.
Yeah, and I'm glad you said that because that was kind of where I wanted to go next, like the profile, at least from the institutional standpoint of these investments. So, what's the cap rate range? You gave us the spread between kind of different risk profiles, but in today's, we're middle of 2022. I know cap rates have softened a bit over the last few months as mortgage rates have risen dramatically. Um, where are cap rates across this gamut of risk? I mean, are you buying the over 55 at a 4.5 cap? So talk us through cap rates. Talk us through typical deal sizes. How many lots? How many? Uh, what's the dollar size? Kind of talk us through the profile of one of these investments.
Yeah, sure. The so the what well I'll kind of set the stage. What's happened? So I started in the space in 2010, and what was kind of funny, and I chuckle now, is like a lot of my peers were getting assigned the malls, regional malls, office towers, etc., and I got assigned to manufactured housing, and I was like, well, all right, whatever, I'll learn it, understand it. And it turned, fortuitously, now it's probably the lowest cap rate property type, even in a lot of instances, up to 50 points inside of Class A multifamily. And so what's happened is the which used to be largely mom and pop ownerships, very fragmented ownerships, where you'd have hundreds of owners of these really top quality, top notch assets, has basically been gobbled up piece by piece and chunk by chunk by all the big players in the space. And so now, like in Florida, for example, um, there may have, 10 years ago, there might have been upwards of 150 Class A assets that were owned by various families, individuals, small operators. Today, there might be 20 left. And you can be certain that of those 20, every single
Wow.
acquisitions player at every single shop has them on a first name basis and is trying to buy them eventually. So you've seen cap rates, which, it's mirrored apartments, the compression, but I would say in the last, and I would say it's gone so that the top tier, the absolute best in class stuff is trading well into the threes. Um, and it really has it stayed pretty steady because of that inflation factor that I talked about, where on apartments your rent growth assumptions, yeah, you're driving them sky high, but here it's you know, I guess if you're getting leverage at uh, what do you, let's just say a 5% rate, um, you're going to be very certain that in this, like this year, you're going to get 8%, 9% rent growth. So you're going to be, you might be buying it at a 3 cap, but within a couple years, you're going to be positive on leverage. So it hasn't really moved cap rates, and there's so much depth and so much hunger for the space that cap rates have stayed pretty steady. Inevitably, I think we'll see a little bit of that backing off, um, but not too much yet. So, was that a good description?
That's a great description of it. Yeah, and the inflation hedge makes sense that you wouldn't see an expansion in cap rates in this space as much as you might say in a a credit backed lease, like lease to Amazon with 2%
Right.
annual bumps, or even more so, what I spent a lot of time the last couple of years in single tenant retail, where there are no bumps for Walgreens, for instance, has no bumps in a 60-year lease. And so you would expect with that sort of lease, you're going to have a fairly large expansion in cap rates to account for inflation. And,
Mhm.
and what you're describing is a scenario where cap rates can hold because you're protected entirely through a
Mhm.
CPI bump in the lease. So that's fascinating. We're running out of time. I want to be
And
sensitive to
think
you, but let
about.
me ask this. Go
Oh,
ahead.
I was just going to add, so yeah, you've got all the U.S. institutional investors, all the, I reference it as New York money. Um, But in addition, now you've got international pension funds and sovereign wealth funds that understand the dynamics, and that U.S. Basically it's a bond. It's as close as you can get to a bond, but with equity characteristics, and it's hyper attractive if in these other low interest rate economies across the world. So there's a lot of foreign money has entered the space as well.
Yeah, and that institutional capital, as you described, is going out and really gobbling up, consolidating in the same way that all these small banks were consolidated in the '90s. Remember when I was a kid, there were a million banks, and then there were a handful of major banks that consolidated most of the banks. It's really that's happening. How about new supply though? And this is where I want to finish. It's there's developers in the space. But what I've been told is that there are significant barriers to getting this product approved in the market. Talk to us about supply opportunities, and for our listeners who maybe have an interest in developing this sort of product, what sort of opportunities exist there?
Yeah, it's the that's always been the other benefit against, call it, apartments, for example, is because it's incredibly difficult to build new supply, especially at the 55 plus um, and all age tier. RV parks is a little easier because you're literally laying concrete, electric hookups, utilities, and you can do that on a pretty efficient scale. To build an MH park, one, you got to get it zoned. And because there's a lot of misunderstanding about the quality of the property types out there, there's a lot of NIMBYism. It's really hard to get them zoned. I think this could be folklore, but up until recently, I don't think there hadn't been a park in California developed since the early '90s. So think about that. Zero new supply. Um, and but then above and beyond that, let's say you could get it zoned on the best corner in town. You've got to then buy the land, which is going to be expensive. Then you've got to invest upwards of which geez, 3 or 4 years ago it was 35, 40,000 in infrastructure costs, is probably 60 to 65,000 today up front before you even get a drop of
Hmm.
income. So you're building roads, sewers, utility hookups, everything. You're going to build an amenity package, um, and so it's a heavy, heavy, heavy upfront investment. Then you have to have you have to have a marketing and sale program, much like a single family home community. You have to get 300, and I say 300 because 300 lots is kind of like the core type of a community. 200 to 300 is, in that ballpark. You got to get 300 people to come and buy homes,
Right.
invest, new. When I referenced 50,000 earlier, that's a resale. That's an old home from the 80s, 90s, 70s in some instances. New homes are 120 to 150. So you got to have 300 people willing to pay 150,000, and largely with all cash. There is a little bit of financing out there, but so that can take years and years to lease up. I think in the heyday of MH development, which was probably in the mid 2000s, probably 2000 to 2006, you'd see a lot of parks in Florida that would go 50, 60 to 100 homes a year. And so they were just cranking them out. And, these days to envision, there may be a few like that, but that would be exceedingly rare. So if you're going to underwrite that, the most you could realistically underwrite is 25 to 35 a year. And that's pretty aggressive. And if times like right now, that might come to a grinding halt pretty quick. So that's kind of the development dynamics. But if you can figure it out, and you can do what I would say is like phases. So maybe you get a little piece of land, you want to put 70 or 50 lots. You could do a road and do the first 12, and just kind of stagger your capital investment. That's how a smaller investor could feasibly build one of these things out. But to do an institutional caliber one would be extrememely rare. Nobody that just tells you how rare it is, because nobody can really do it. The only way you can do it is if you have a piece of extra land tied to your existing community, and you've got tons of cash flow, and you can start fronting the CapEx on the other phases. So pretty good supply side. Now
That's fascinating. I mean, yeah. I mean, it's a strong demand with as good of credit protection as you'll ever find. You have the CPI bumps, and then you've got these significant barriers to new supply. It is the quintessential ideal investment. And to a comment you made earlier, there'd been a stigma for a lot of years around MHC, and a lot of investors had steered clear because of what you were describing. But it's the secret's out. Thanks, Brandt, for your time. I mean,
and I'll say, Spencer,
as I was saying at the beginning.
Sorry to interrupt. The ones that I'm referencing, no. I mean, if you were to walk through them or drive through them, you would have no idea it wasn't a single family residential community. I mean, there are so many incredibly nice ones. I always joke with my wife, like, hey, we could have a place in Phoenix and a place in Sarasota, but we live in an MH park. And so maybe we'll get there someday.
I'm envisioning Brandt in his retirement. He's got his 3 MHC homes around the country. I love it. Well, thanks again for your time. Yeah, I know you're busy. And for the listeners who perhaps want to reach out to Brandt, we'll make sure to include his LinkedIn profile in the description. So with that, let me turn it back to Sam to wrap us up.
Yeah, Brandt, thank you so much. I know I didn't say anything because I was becoming educated in this incredibly interesting subtopic. Well, it's not even a sub. I mean, this thing is from, maybe I don't know about it, but this thing is big. It sounds like it's a huge opportunity. So for the listeners, thanks for listening, and we'll see you on the next podcast.
Thanks for tuning into this episode of the Adventures in CRE Audio Series. For show notes and additional resources, head over to www.adventuresincre.com/audio series.